Good afternoon, everybody. Thank you so much for joining us here today. My name is Ty. I'm a community engagement specialist here at the Harvard University Employees Credit Union. We are so thrilled today to bring you a presentation about student loan repayment and refinancing, a very apt presentation with today's current climate and calendar. So I'm joined today by our two experts here, Rafaela Dowie and Mel Martinez. They're going to be doing today's presentation. But before we get into the content of today's presentation, I do just want to do a quick few Zoom housekeeping details. So we're in webinar mode today, which means that all attendees are automatically muted and their cameras are off. So please feel free to eat your lunch, enjoy, take a break, and just soak in today's content. If you do have any questions or any comments today, we do recommend you use the Q&A feature of Zoom. It's down on the bottom there. Rather than the chat function, chat will be automatically disabled for attendees, but please do ask any questions through the Q&A feature. We definitely want to make sure that any questions we get, we are answering. We're going to have time for Q&A at the end of today's presentation. So we'll be collecting any questions during the presentation, and then we'll have some time towards the end to answer those questions. And just to make sure that that feature is working, we want to make sure that we're getting in information now. And as we wait for attendees to kind of trickle in, I would like to ask everyone to please, if you can, just hop in the Q&A feature and just let us know where you're joining us from, as well as if you want to include if you're a member of the credit union at this time, that would be great. We like to know if we're reaching members, non-members with our content, and any information you guys can provide would be awesome. So I'll wait and see if a few of those come in. But while that happens, I did also just want to mention that we record all of our webinars and they are all available for free on our YouTube page after today. So that's YouTube/myhuecu.com. You can review this presentation as well as our many other hundreds of presentations, video content that we do on all sorts of financial wellness topics. So I can see a couple people have reported in. We've got somebody from Burlington, Beth Israel Leahy Health. A couple people are members, a couple people are not. We welcome everyone. We have all sorts of resources, whether you are not a member, and we hope to see you, maybe join in the future. But for now, welcome. All right, let's get started. So a little bit of information about the credit union before we jump into the presentation. Credit unions are different from big banks. For one major key difference is that we are a not-for-profit organization. This means that all of our members are actually partial owners in the credit union, and all of the profits that we do make as a financial institution, we give back to our members and to our community. This translates to better value, a lot of better interest rates for products, things like that. We have other fee waivers and other things that are included in our services as well as part of the way that we give back. We do a lot of charitable giving and volunteer events and work directly with our community. So we really strive to make sure that everyone knows just how important our community is and each and every one of our members are. We really work hard to take any and all feedback from our members and from the community and give back in any way that we can. So that's the 101 on why credit unions are different from banks and how we strive to give back. So including one of those benefits is Thrive. This is our sort of financial website platform where there's all sorts of different financial counseling workshops you can do on the website. We partner with GreenPath, which is a financial wellness and individual counseling company, and they work with our members, and not just members, but anyone that's referred through the credit union, to provide free one-on-one counseling and all sorts of other financial wellness courses and things like that. So after today's presentation, if you're wondering how this applies to you individually, definitely check out Thrive and GreenPath on the website. But for now, I'm going to kick it over to Rafaela, who's going to begin today's presentation about student loan repayment. Thank you guys so much for joining.
Great. Thank you, Ty. Thanks everyone for joining our webinar today. My name is Rafaela Dowie. I'm the Education Lending Origination Supervisor at HUECU. During today's session, we'll walk you through the steps to take to pay off your student loans. We'll start with helping you first understand the types of student loans and the differences between them. Next, we'll review the repayment options that are available and how they work. We'll also cover information related to federal student loan forgiveness and discharge, which are available in certain situations. Finally, we'll discuss student loan refinancing and explain how this works to help you decide if this may be an option for you. Next slide, please. So we'll get started by explaining the different types of student loans that are available so you have a better understanding of how each loan works. There are three main types of student loans. A federal student loan is a loan provided by the U.S. government to eligible students or their parents or guardians to help cover the cost of higher education. Since funds are distributed directly from the government, they are a dependable option for financing education. These loans include direct subsidized and unsubsidized loans, and direct plus loans, of which there are two types, the Parent Plus and the Graduate Plus. The FAFSA is required for all federal loans. Since federal loans offer different benefits than private student loans, it's recommended that you explore them first. State loan programs provide supplemental funding for eligible residents to reduce their educational costs. These loans generally have similar terms and requirements to federal direct loans. These loans are available through government agencies of your particular state. Programs can vary from state to state, so it's important that you consult with your state's Department of Post-Secondary Education for details about these types of student loans. Some states will only require the FAFSA to apply for these loans, while others require families to complete a separate application. Some examples of loans offered to Massachusetts residents include the Massachusetts No Interest Loan. Eligibility amounts for this loan vary based on financial need. Private loans are non-federal loans made by a lender, such as a bank, credit union, state agency, or school. These loans can help to cover the gap between your cost of attendance and any financial aid you are receiving after you've explored scholarships, grants, and federal or government-funded loans. Terms and conditions for these loans are set by the specific lender you are borrowing from. Next slide, please. Federal direct subsidized and unsubsidized loans. You may see direct loans referred to as Stafford loans, which direct loans were formerly known as. The student is the primary borrower for these types of loans, and there is no credit check required to borrow. Students may defer payments on these loans while they are enrolled in school at least half time and during the grace period. The grace period on federal loans is a 6-month period where no payments are required after a student graduates, separates, or drops below half-time enrollment at the school. Interest rates are based on the loan rate at the time you borrow the loan. Federal direct subsidized loans are available to undergraduate students who demonstrate financial need. The Department of Education pays the interest on subsidized loans while the student is enrolled at least half time and during the grace period. Your school will determine how much you are eligible to borrow for the subsidized loan. Federal direct unsubsidized loans are available to undergraduate, graduate, and professional students. There is no requirement for financial need for these loans. The eligibility amount is determined by your school based on your cost of attendance and any other financial aid you may be receiving. The student borrowing is responsible for the interest that accrues from the date of disbursement on this loan, but the loan will be deferred while the student is enrolled and during the grace period, so no minimum payment is required during deferment. Borrowers can still pay the interest that accrues during this time if they wish to do so, and that will certainly help to reduce the total amount of interest accrual on the loan. As I mentioned, FAFSA is required for all federal loans. Next slide, please. There are two loans that fall under the federal direct plus loan category, the Parent Plus loan and the Graduate Plus loan. The Parent Plus loan is available to the parents of dependent undergraduate students. The Graduate Plus loan is available to graduate and professional students. A credit check is required for all plus loans. Borrowers must not have an adverse credit history for approval. If you do have an adverse credit history, you may still be able to borrow a plus loan if you meet additional requirements. The maximum amount of this loan is your school's determined cost of attendance less other aid you are receiving. Interest rates depend on when the loan is dispersed. The Parent Plus loan will enter repayment immediately. With that said, deferment options are available. The Graduate Plus loan has a 6-month grace period after graduation or separation before payments are required. But again, you can make payments during the enrollment period and during the grace period. Next slide, please. Thank you. Private loans are non-federal loans that can be used to pay for college costs. They come from a lender, such as a bank, credit union, state agency, or school, instead of the federal government. These loans can help to cover the gap between your cost of attendance and any financial aid you are receiving after you've explored scholarships, grants, and federal loans. Terms and conditions are set by the specific lender. If you're borrowing a private loan, it's very important to ensure you understand the terms of your loan and that you keep in touch with your lender about any questions you may have. These types of loans often require established credit or a creditworthy cosigner. Options are available for undergraduate, graduate, and professional students, and the products vary by lender. Not all private student loans are the same, so interest rates, repayment options, and other terms can vary from lender to lender. Be sure to do your research and fully read your disclosures to ensure you understand how your specific loan works. The FAFSA is not required, but encouraged to ensure you are receiving other aid you may be eligible for, such as grants, scholarships, or work study for private loans. Next slide, please. More details and resources regarding each loan type are available at studentaid.gov. When you visit the site, you'll be able to see the specifics related to federal loan eligibility amounts and loan limits, interest rates, and the terms of each loan. There are a number of other resources available on this site, so I would encourage you to review the information to ensure you have the best understanding of how your loans work. You can also use the site to review current federal student loans and servicer information. The link will be available in the chat. Next slide, please. It's a really good idea to review your credit regularly. By visiting annualcreditreport.com, you can receive a free weekly copy of your credit report from each of the 3 bureaus. It's also a great option to view all of your student loans in one place, since private lenders or private loans will not show up on studentaid.gov. That will only show federal loans. Use this site to review your credit score and ensure you are on top of your finances. All right. And I will turn it over to Melanie.
Thank you, Raf. And thank you all again for joining us today. My name again is Melanie Martinez, and I am the Loan Servicing and Support Supervisor here at HUECU. So I'm going to jump in to step 2, which is knowing your repayment options. Next slide. All right, so knowing your repayment options is key, especially with federal student loans, since they do offer a variety of options once you've officially enter into repayment on your loans. And so we'll start with their fixed payment repayment plans, which include the standard repayment plan, the graduated repayment plan, and the extended repayment plan. These plans base your monthly payment amount on how much you owe, your interest rate, and a fixed repayment time period. When you leave school, you are automatically enrolled in the standard repayment plan, which has you pay a fixed monthly payment amount that ensures your loans are paid off within 10 years. The graduated repayment plan starts you off with a lower payment amount that gradually increases typically every 2 years, and is also calculated to ensure that the balance is paid off within 10 years as well. Now, under the extended repayment plan, payments can be fixed or graduated, but are calculated to pay the loan off within 25 years versus 10 years. And another detail to highlight about the extended repayment plan is that you must have more than $30,000 in outstanding direct or FFEL program loans in order to be eligible for this particular repayment plan. These options are not available for private student loans. They're only available for federal student loans. And if you want to be placed on one of these repayment plans, you can contact your loan servicer directly. And these options are usually or can typically be requested and processed by a representative right over the phone. Now, moving over to the right side of the screen, federal student loans also have several income-driven repayment plans available. We won't go into the individual details for each one right now, but I'll highlight the facts that apply to all of the IDR plans across the board. As suggested by the name, income-driven repayment plans base your monthly payment amount on how much money you make and your family size. The Department of Education offers 4 IDR plans, which includes income-based repayment, or IBR. This was actually the first and original IDR option. Then you have pay-as-you-earn, or PAY, save-in on a valuable education plan, or SAVE, and then lastly, the income contingent repayment plan, or ICR. After satisfying a certain number of months of qualifying payments on one of these IDR plans, you can get the remaining balance of your loans forgiven. Because payments are based on your income and family size, you must provide your loan servicer with updated income and family size information each year so that your servicer can recalculate your payment amount each year. This process is called recertification. And so you must recertify your loan even if there has been no change in your income or your family size. However, if you agree to the secure disclosure of your tax information, the Department of Education and your loan servicer will automatically recertify your enrollment in IDR and adjust your monthly payment amount once a year. So that's an easy way to have your income-driven repayment plan recertified automatically. You'll also be notified when your payment is changing, and you'll always be able to recertify your plan manually as well. To get the full details on each of these options, like what percentage of your discretionary income is used to calculate your payments, you can visit studentaid.gov, where you can also submit your application if you are eligible. And then I also want to mention the other income repayment plan that's listed on this slide, called the income sensitive repayment plan. And however, despite the name of this particular repayment plan, it does not fall under the income-driven repayment plan umbrella. So a few things to highlight about this particular option is that the monthly payments can increase or decrease under the income-sensitive repayment plan, and they are made for a maximum period of 10 years, unlike the 20 to 25 years under the other IDR plan. And also, there's no forgiveness attached to the income sensitive repayment plan. So if the loan isn't paid off within the 10-year period, you are still responsible for the remaining balance. And then lastly, only FFEL loans are eligible for the income sensitive repayment plan. So if you have a direct loan program, then that loan wouldn't be eligible for this particular repayment option. And then I also want to mention that if you have Perkins loans, please keep in mind that the repayment options are not the same as those for direct or FFEL program loans. So you should check with your school for more information on any Perkins loan repayment plans that are available to you. Next slide. All right. So deferment and forbearance. These are options you can use if you're experiencing a short-term financial bind. And so if you're eligible for any of these options allow you to temporarily suspend your payments, or in some cases, reduce your monthly payment amount. Reasons such as economic hardship, unemployment, or serving in the military are just a few examples of why you may apply for a deferment or forbearance. And something to keep in mind is that in most cases, interest will continue to accrue during your deferment or forbearance period. So this means your balance will increase and you'll pay more over the life of your loan, which is why these options are only recommended when you truly need them. Now, the difference between deferment and forbearance has to do with interest accrual. So with federal student loans specifically, interest doesn't accrue on some types of loans during a deferment period. And during a forbearance, interest will accrue regardless of the loan type. Now, with private student loans, interest will typically accrue during both a deferment or forbearance period. So there's no subsidy attached to private student loans when it comes to either of these options. And another thing to note is that not all private student loans will offer forbearance or deferment options. And if they do, the options are typically limited in comparison to what you'll find with federal student loans. Also, keep in mind that there are usually eligibility requirements for for deferment and forbearance, and you will generally have to submit documentation to your servicer or your lender in order to qualify and actually have it applied to your loan. You may be able to apply for certain deferment or forbearance options on your servicer's or your lender's website, but you should call in to either or directly to discuss your options if you're ever unsure or unclear of what's needed in order for you to move forward. Next slide, please. Now, what happens if I miss a payment? If you miss a payment, I'm sure you can assume, like most financial obligations, there are some consequences that will follow. And so one of the big consequences is that your credit report will be negatively impacted. So your loans would be negatively reported to the credit bureau, which of course can impact your credit score. Most services begin reporting once your loan is at least 30 days past due. And then becoming too far past due can then lead to default. And that typically means being assigned to a collection agency at that point, and then incurring additional fees as a result of collection costs. Default can also prevent you from borrowing additional loans, whether they be federal or private student loans. And the government can also garnish your wages to pay off your defaulted federal student loan debt. So ultimately, you can end up significantly increasing the overall amount you have to repay. So we encourage you to open all mail related to your student loans, just so you're not missing any important notices or bills, and set up automatic payments if you're able to. There's usually a discount associated with setting up recurring payments for your education loans. And then it also helps with keeping you just on top of that monthly payment. And also, lastly, I would say just reach out to your servicer if you're facing challenges that impact your ability to pay, because there are options like deferment and forbearance that I just discussed that can help you get back on track before you fall too far past due. Next slide. All right. So forgiveness and discharge options, the popular topic. Most people would love to have their loans forgiven if able. You can go to the next slide. In certain situations, you can have your federal student loans forgiven, canceled, or discharged. That means you won't have to pay some or all of your loan back. And as you can see here, there are a lot listed on this slide. However, public service loan forgiveness is the most common way people apply to have their federal student loans forgiven. So that's the option we'll highlight today. So let's go ahead and get into it. You can go to the next slide. All right. So public service loan forgiveness is or also known as PSLF, is a federal program designed to encourage students to enter low-paying careers like firefighting, teaching, some government positions, and so on. And there are a number of qualifying factors for PSLF that I'll highlight. So first off, you must be employed by a U.S. Federal, state, local, or tribal government, or qualifying a not-for-profit organization. It's important to keep in mind that qualifying employment for PSLF isn't about the specific job that you do for your employer, it's about who you work for. You must also work full-time for that agency or organization, which means a weekly average of at least 30 hours. And you must have direct loans. So if you have an older FFEL loan or a Perkins loan, you can make those loans eligible by consolidating them into the direct loan program. However, by themselves, they are not eligible for PSLF. You also have to repay your loans under an income-driven repayment plan or the 10-year standard repayment plan. In addition to being under a certain repayment plan, you also need to make a total of 120 qualifying monthly payments that do not need to be consecutive. So if you have a period of employment, with a non-qualifying employer, you will not lose the payment counts for prior qualifying payments that you made under an eligible employer. Payments made during COVID, during the COVID pause that the Department of Education put on federal student loans, those will count towards PSLF as well, as long as you meet all other qualifications. And the Department of Education created the PSLF help tool that allows you to search for a qualifying employer. So you can check out whether or not your employer is eligible. And you can also learn what actions you may need to take to become eligible for PSLF, and generate the form itself to submit. So if you think you may be eligible for PSLF, please use that help tool to confirm that your employer qualifies, and then go ahead and submit the form. MOHELA is the servicer that currently oversees PSLF for the Department of Education. So they are responsible for reviewing and processing the certification forms that are submitted. And if MOHELA doesn't already service your federal student loans, your loans will automatically be transferred to them once the form is processed. And then once you reach that 120 qualifying payments, MOHELA will confirm your eligibility and then go ahead and forgive the remaining balance of your loan. So you can find out how many qualifying payments you've made by logging into your account with MOHELA, and viewing your loan details, or by looking at your most recent billing statement. You can also reach out to MOHELA directly with any questions you might have specifically about public service loan forgiveness. And then I did also, it's not listed here on this slide, but I did also want to highlight the temporary changes that were made to PSLF as a result of the pandemic. And it falls under the abbreviation TEPSLF. And so basically under that temporary adjustment, the Department of Education is temporarily bending the rules on which payments count toward forgiveness under PSLF. So if some or all of the payments you made on your direct loan program loans were under a non-qualifying repayment plan for public service loan forgiveness, you may still be eligible to receive loan forgiveness under this temporary expanded public service loan forgiveness option. The additional qualifying repayment plans include the graduated repayment plan, extended repayment plan, consolidation standard repayment plan, and consolidation graduated repayment plan. These plans don't usually qualify for PSLF, but under this temporary adjustment, they will qualify for it. Your payments will automatically be considered for PSLF and TEPSLF after you submit the form to MOHELA. And like the standard PSLF, only direct loans are eligible. If you have a FFEL program loan, you would have had to consolidate those loans before the end of 2023 in order for them to be eligible for this temporary adjustment. So if you did not consolidate your loans before the end of last year, unfortunately, you would no longer be eligible for the temporary adjustment. There are other qualifying details you will want to review before moving forward with either option. So I highly encourage you to visit studentaid.gov, because they will again have the most up-to-date and accurate information regarding this option. And you again use the PSLF help tool for the PSLF and TEPSLF to make sure you're covering all your bases. You can also, again, contact MOHELA directly with questions. And the last thing I will mention regarding the forgiveness and discharge, is that these options do not apply to private student loans, such as the education loans offered through HUECU. So private lenders may discharge a loan due to death of the primary borrower, but that is typically the extent of their discharge and forgiveness options. Next slide. And I will swing it back over to you, Raf.
Thank you, Mel. All right, next slide, please. Okay, considering refinancing. Whether your loan has just entered repayment or you've been making some payments for quite some time, it's a good idea to do research to determine if refinancing student loans might be the right option for you. Next, we'll cover the reasons you may want to consider refinancing, how it works, and how refinancing may be able to help you reach your financial goals. Next slide, please. Thank you. So what is refinancing? A refinance loan is a new loan that combines multiple private and or federal loans into one new loan with one interest rate and payment. Refinancing may be beneficial for those who are looking for a more favorable borrowing terms, such as a lower monthly payment or a lower interest rate, or those who are looking to pay all of their student loans in one bill. Some borrowers may consider refinancing their loans if they learn they are eligible for an interest rate that is lower than the rate they have on their current loan or loans. Borrowers may also consider refinancing if they have a variable interest rate and they're looking for more stability with a fixed rate. Refinancing may also make sense for a borrower who is looking to extend their term to reduce their monthly payment. Although, by doing this, you may increase the total cost of the loan because you're extending the amount of time that you're paying interest on it. There are typically no prepayment penalties on refinance loans, so they can be paid off early without penalty at any time. But be sure to check with your lender to confirm the terms and conditions for your specific loan. Finally, please understand that federal consolidation is different from private refinancing. Federal consolidation allows borrowers to consolidate one or more federal loans into a new direct consolidation loan for the purpose of lowering your monthly payment amount or gaining access to federal income-driven repayment options or forgiveness programs. Next slide, please. So what to consider before refinancing? One of the most important things to consider when refinancing is the interest rate. You'll want to review your current rate and the potential rate you'd receive by refinancing. Interest rates are typically based on your credit file. Lenders often allow you to receive a rate estimate before applying as part of the pre-qualification process. They may call this find my rate or get pre-qualified. Usually this involves a soft credit pull, and this will give you a rate estimate. If you want to move forward, you would complete the full application process. If the interest rate is lower than your current rate, or if you're looking to switch from a variable to a fixed rate, refinancing may be a good option for you. Choosing a longer repayment term may result in a lower payment, but again, this may cause you to pay more over the life of the loan. Choosing a shorter term may result in a lower rate, but you may have a higher monthly payment. So it's important to pay attention to these factors. It's also very important to consider the benefits you may be losing by refinancing. For federal loans, you will lose benefits such as interest or payment waivers, potential loan forgiveness, flexible federal repayment plan options, and federal loan discharge options. I did see a message in the Q&A or a question regarding refinancing parent loans. So these are some of the things you may be missing out on if you were to refinance a federal loan with a private lender. Please note that you can choose to refinance some loans and not others. If you are interested in just refinancing your private loans, you can certainly do that. Repayment on refinance loans typically begins immediately, with the first payment being due 30 days from the disbursement date. Be sure when you refinance, or if you decide to move forward, that you continue making payments on the loans you are refinancing until you've received confirmation from that lender that these loans have been paid in full. Next slide, please. Okay, repayment strategy. So this chart shows an example of how refinancing can be beneficial. The current loan has a higher interest rate at 8.5% and a remaining term of 103 months or 8.6 years. You can see here how the lower rate impacts the total cost of the loan, even with a longer repayment term. If you make the same payment on the new refinance loan, you'll be saving on the total cost and paying the loan off faster than the current loan. You can see the power of refinance by making an increased payment on the new loan, as shown by the example as well. You can replicate a chart like this to help you decide if refinancing your loans may be right for you. Next slide, please. So as a benefit of your credit union membership, you have access to GreenPath Financial Wellness. GreenPath offers free expert credit, housing, budget, and debt management counseling, including federal student loan counseling. Our counselors will work with you to understand your financial situation and help to develop a personalized plan that works for you. There are a number of other resources available on the site, such as free webinars and articles to help you increase your financial awareness. Learn more by visiting GreenPath or huecu.org/greenpath. The link will be in the chat, and as I believe Jen mentioned, you don't need to be a member to take advantage of these resources. Next step. Thank you. So now that we've covered the student loan basics, you have some work to do. First, you'll want to review the types of student loans you have and how these loans work. The next step would be to research your repayment and loan forgiveness options to ensure you understand which options are available to you. Finally, take a look at your current loans and do some research to determine if refinancing may be the right choice for you. I will pass it back over to you, Ty.
All right, thank you so much, Rafaela. So just a couple last minute things here. We do love any and all feedback related to our webinars and how we're doing as an organization. So there will be a survey sent out after this presentation, I believe in the post webinar email that you guys will get. If you can take a few minutes just to review the survey and submit your feedback. We read personally each and every one of the responses we receive from our surveys. We really are always trying to improve, make sure that we're answering all the right questions, approaching content from the right direction. So please do let us know if there's anything you think we could do better, or if you think there's anything in particular you really liked. We love that. As the credit union, we're always trying to make sure that we're working with the community. So thank you very much for doing that. A small disclaimer here, please don't sue us. These presentations, our webinars are designed for educational purposes only. The content within them is sort of an overview of the situation, an overview of the information. If you're interested in, well, this is, I should mention also, not tax or legal or investment advice. If you're interested in figuring out how these sort of larger concepts relate to your own individual situation, that's what resources such as GreenPath are for. And as mentioned, you don't even need to be a member to be able to take advantage of GreenPath. If you go to the website or give them a call and let them know that the HUECU referred you, you will be eligible for these resources, and they will be more than happy to provide one-on-one individual counseling that fits your own unique individual situation. So thank you guys so much. Please do keep in touch. We have all sorts of social handles here, and we're going to take just a couple minutes here if anybody else has any additional questions or anything like that. I know we had a few come in during the presentation, but it looks like they were mostly answered. But yeah, please do let us know now if you have any questions. Other than that, we're going to give you guys some of the time back here, but we'll let it sit for a minute or two while we have our experts here on the line. And as I mentioned, one of the social handles here is our YouTube page as well, where this recording will be able to be found shortly after the time. So if you were like, oh, that was too fast, how am I going to be able to review this? You can always go to the YouTube page. We have this as well as all of our other content. But it does look like a couple questions are coming in here. So let's see. First question here is it possible to put the Parent Plus loans under my daughter's name so that the income-based plans are based on their income or lack thereof?
Unfortunately, no. Their Parent Plus loan cannot be transferred to the student's name. So yeah, short answer, no.
Yeah, that's too bad. Okay, we have another one here. What do you suggest for students who are currently working but are thinking about going back to school?
I can take that. For students who are currently working but thinking about going back to school, it really depends on the type of program they'll enroll in and if they'll be working while they're enrolled in that program. Different, like as we mentioned, certain like undergraduate programs offer they're eligible for federal loans, so those options would be available. If they're seeking funding from a private lender, we would look at certain things would be looked at, such as income. Potentially, if they don't plan to work while they're in school, they could possibly borrow a loan with a co-signer, depending on the lender they're looking at. So those are some options that would be available, but it's a good idea to research what options might be available to the student if they were to go back to school, and also to come up with a plan of if they're going to work full-time, part-time, or not at all while they're going through the program.
Thank you, Raphael. That's great. Okay, well, it looks like that's all of our questions this afternoon. Thank you all again so much for joining us. Please do keep an eye out for the survey and post-webinar email that will be sent out with more information as well. So thank you all. We've been Harvard University Employees Credit Union, and I hope you guys have a great rest of your evening.